Hello and very warm evening to all the HDFC securities customers. It's a very big thanks for first of all from all the from all the staff and HDFC securities team for all our customers who have taken time to come out and attend this webinar. We are very grateful to have Mr. Prashant Jain, a very well name in the industry, though he doesn't need much introduction, but I'll still try to make some effort. So Mr. Prashant Jain is Executive Director and Chief Investment Officer with HDFC Asset Management Company. It is one of the largest AMC which we have. Mr. Prashant has more than 3 decades of experience, and he manages one of the largest funds in the industry on the equity side. So Prashant, we are very happy to have you back as to attend and to discuss with our investors. Very good evening, sir.
Good evening, and thank you very much for having me here. And very good evening to all of you, friends.
So, Prashant sir, the reason for having or requesting you to come over and have a small discussion with our customers is because all our customers are now really perplexed looking at the kind of things which are changing in the market, starting from interest rates to the geopolitical tensions. They are anticipating what RBI is going to do. The FPI movement is anyways troubling them, or in fact showing different trends in the market, and overall the inflation number, which is always a worrisome when it goes up beyond a certain level. So, and finally, people are here to understand what is the equity outlook for the year of going forward. So, without much ado, I'll request you to take us through your views, your opinions across.
So, thanks, Abhishek, and thank you once again.
My pleasure, sir.
Let me come straight to share some thoughts around the markets and the economy. So I think the markets have, to my mind, and this is a judgment, one could be wrong, but I feel the Ukraine, the oil prices spike, the state elections, and to a very large extent, the FI selling, the very large FI selling that we have seen over last few quarters. I think these factors have been by and large absorbed or discounted by these markets. And it was for the first time in my career, I witnessed that FIs have sold close to 30 billion and markets have not really been much impacted. So while you may worry about the FI sales, but I think the thing to feel good about is that I think equities in India have become a core asset class over time. And when I started career, they were a peripheral asset class. People used to look upon equities as speculative or only for trading. But I think we have come a long way. And if you look at the number of demat accounts that have doubled in last 2 years from 4 crores to 8 crores, or if you look at the very persistent flows into domestic institutions, whether it is mutual funds or insurance, I think they suggest that equities, people have understood it the right way, and more people, investors, are now looking at equities as a long-term asset class, and that's the reason that despite so much of FI selling, the markets have held steady. On earlier occasions, we have seen that when FIs would sell, even locals would panic and they would also start selling, and that would lead to a very deep correction in the markets. That's what happened in 2000. That's what happened in 2008. But fortunately, I think this time around, it has been a very different outcome. So I feel to that extent, one should not worry too much about FI sales because local investors, local institutions seem to have come of age. I think economic outlook of India is, to my mind, quite positive. One, I think we have carried out a lot of important reforms over the last several years. And I think if you go back 10 years or slightly longer, we used to see negative headlines around regulatory challenges in one industry or the other. Sometimes it was telecom, sometimes it was mining, sometimes it was airline, sometimes it was infrastructure. But look at the headlines today. There are no adverse headlines concerning business. So I think the regulatory environment in India, the regulatory framework has improved significantly. And I think this is an environment that is quite conducive to business and to investments. Our taxes have been stable for few years, so much so that the budget speeches are becoming, less. They are becoming shorter, and there is very little tax changes in those budget speeches, which is actually a very good thing. The government spend on infra have clearly gone up, and we are seeing good progress in roads, in railways, in urban infrastructure, in airports. We are seeing significant progress in renewable power, etc. Even the outlook for private capex, to my mind, is quite decent because corporate debt to equity ratio, corporate leverage is close to a 15-year low. There has been a very broad-based revival in profitability, especially in the manufacturing sectors. So whether it is metals, whether it is chemicals, whether it is textiles or sugar or paper, we see fairly broad-based revival in corporate profitability. I think what started off as a hope as turning to reality, and there is increasing confidence in the view that India is indeed gained comparativeness over China in manufacturing. So now when we talk to companies in the manufacturing sectors, whether it is chemicals or textiles or engineering, Indian companies are quite confident of competing with Chinese costs. Our costs have not gone down, but I think their costs have gone up. Chinese per capita income is now 5x of India, and their manufacturing wages also are nearly two times of Indian wages. So I think because of higher wages in China versus India, because of improved compliance to environment, because of a sense of urgency to reduce carbon footprint, and therefore China is de-emphasizing on carbon negative industries, because the world experienced disruption in supply chain, especially because of the over dependence on China during COVID times. I think there is also a keen desire amongst buyers in the world to develop an alternate source. So I think all of this put together has created an environment where Indian companies, India should be able to significantly improve its manufacturing share over the next decade or so. I think the government is also aware of this opportunity. We missed this opportunity 20 years back when China moved decisively ahead. India did well on the services side, but we clearly missed the manufacturing opportunity. I think this time around, the government is very focused to help Indian companies improve their market share. And the PLI scheme, which is still work in progress, I think it's a very well designed, transparently, objectively, and administered in a time bound manner. Uh, I think it should help Indian companies to improve their share in manufacturing. This is such a big opportunity that even if we improve our market share marginally or modestly, it has the potential to increase India's GDP growth rate by 1 to 2% for many, many years to come. I think what IT did for last 20 years, I think now manufacturing to some extent can replicate that. You mentioned there are some concerns around inflation. So I think that's a very valid issue, and inflation is a burning issue. I think what has happened because of ESG concerns, because of the environment post Lehman, the world has not invested enough in conventional forms of energy. And if you look at the worldwide oil and gas capex, it has been quite low in the last 5 years compared to the previous years. So I think what world energy demand continues to grow, and this is a thought we have been expressing in our yearbook for last two successive years, and it seems to be coming true. So I think, and if energy prices go up, it leads to higher wages because energy is a pretty decent component of low income household budgets, between 15-20%. So wages will have to go up. It is a uh, it impacts logistics costs. Therefore, prices of goods go up. It impacts services because apart from wages, energy is also a key input in many services. It impacts the plastics chain. If or crude prices go up, plastics go up. So wherever plastics is used, those prices would go up. If energy goes up, you divert some ethanol from agri to from food to fuel. So food prices go up. Energy is also a key component of the agricultural cost. So energy is all pervasive. So the moment you think about life, you will realize in obvious and not so obvious ways, energy is a component of everything that we do and consume, both in goods and services. I think if energy prices go up, it is reasonable to expect inflation. Uh, how much of where will oil prices stabilize post the Ukraine crisis, post the supply chain disruption because of this Ukraine situation? I don't think anyone has a clear answer, but we are keenly watching that. Where does oil stabilize once this issue is behind us? But I think equity investors need not worry too much about inflation because inflation is to a very large extent a pass through for companies. What is inflation? It is higher prices of goods and services, and which means companies are selling those goods and services at higher prices. So it is widely known, and I have also said it a number of times, that equities is an asset class that increases your purchasing power roughly equal to the real growth of the underlying businesses or real growth of the economy. And inflation is a pass through to a very large extent. So I think inflation is less of a worry for equities investors. It will lead to commensurately higher nominal returns. If you go back in India 15, 20, 30 years back, when inflation used to be a lot higher, in 8 to 12%, even sometimes even higher. I mean, people like me often used to say long-term returns of equities are 14 to 18%. And over the last 10 years, we have reduced that to maybe 12 to 14%. Why? Because inflation in India last 10 years has been lower than what it was 15, 20 years back. That is one more indication that how inflation is a pass-through for equity returns. Inflation is a bigger worry for bond investors, and because bond prices tend to drop, whereas equity prices are reasonably unaffected by inflation. The final point about economy is that the profit growth outlook is quite decent. There was a time until maybe 1 or 2 years back, people like me were always embarrassed at the end of the year. And we would give some reason or the other why even this year Nifty EPS did not grow. Some year the culprit would be bank, some year the culprit would be metal prices, some year the culprit would be some other company. But fact is that because of low capex, low metal prices, and high NPAs in the banking system, the Nifty EPS did not grow at a respectable pace for many, many years. That seems to have changed. Profit growth is quite broad-based now. The banking NPAs are clearly behind us, and I don't think we should worry about that. Metal prices, commodity prices have gone up sharply, and these companies will clearly benefit from that. The users of these commodities will pass that on to the consumer over time, maybe with a 6 month lag, 3 month lag. But commodity companies will benefit clearly. And finally, CapEx seems to be reviving. Order backlogs are good, order pipelines are good. Even this export manufacturing opportunity will support industrial CapEx significantly in India. So I think we are seeing fairly broad-based profit growth in India across sectors. Sectors like FMCG, software, pharmaceuticals, utilities. These are reasonably stable sectors which were not challenged also. And the challenged sectors are now experiencing good profit growth. So I think there is reason to be optimistic on that front. The I think the only negative data point in the economy is the weak credit growth. So credit growth in India continues to be weak. It is in high single digits. Uh, we hope one day it will improve, and whenever it improves, it will favorably impact the banking sector because bank balance sheets are good, NPAs are low, provisioning costs should be very low, and whenever credit growth picks up, it will be good for both top line growth and for margins because banks. I think the environment will also is likely to help them improve their margins. So for the time being, trade growth is weak, but I think there are reasons to believe that it should improve at some point of time. So net, I think the economic outlook of India is better to my mind than what it was pre-COVID. Because during COVID period, I think we have undertaken a lot of reforms, and the I think Chinese manufacturing opportunity has become more real. Coming to the markets, I think the valuations in India are quite reasonable. They are neither cheap, they are neither expensive. If you look at India's trailing returns, last 10, 15-year returns, around 12-13% CAGR, that is in line with the rupee GDP growth over that period. If you look at India's market cap to GDP, if you look at India's PE multiples on a forward basis, I think these are pointing to reasonable valuations, especially keeping in mind the below average prevailing cost of capital. What that means is that while near term is always a challenge to forecast in the markets, that's the nature of the asset class. But if you take a view for a few years, I think it is reasonable to conclude that returns of these markets should be very close to nominal GDP growth rates. And to the extent that inflation remains high, to that extent, I think the nominal GDP growth should also be a bit higher. What are the risks to these markets? I think one risk is clearly oil prices. If oil prices go up even from where they are and they stay there, it will adversely impact India's current account deficit. It could impact adversely even fiscal deficit because government may choose to cut taxes on fuel to help the consumer. Uh, and it could also adversely impact the GDP growth rate because fuel demand is pretty inelastic, and if prices go up, consumers will have lesser money to spend on other things. Having said that, I don't think oil is as big a worry as it used to be 10 years back. And the reason for that is quite simple. Over the last 10 years, the export of software has grown much faster than the import of oil. And therefore, today we are in a situation where net software exports are higher than net oil imports, which was not the case 10 years back. So I think this is the reason why India has handled the spike in oil prices relatively better. We have not seen any instability in the currency markets, despite persistent and large FII selling over last several quarters. So to that extent, I think while we need to be alert, watchful towards oil prices, but I don't think we should worry unduly about this. The second, I think, issue is, which is a very live issue, is in global inflation and US interest rates. US is the world's largest economy, largest supplier of capital, and so if cost of capital goes up there, it should logically impact markets across the world. US inflation is running quite high. US employment data is very strong. Wage inflation is strong. So and we know what is happening to energy prices. So I think if inflation uh, remains higher than what uh, Fed was expecting or is expecting, I think it could lead to higher interest rates over time. I mean, some hikes markets are expecting, but all I am saying is there is a possibility that the yields may actually go higher than what the markets are currently anticipating. If that happens, it will be not good for markets across the world, especially the Western markets. I think while it is not positive for India, the impact should be limited because the gap between US interest rates and Indian interest rates at 5% is quite healthy, is slightly on the higher side. So that means that even if US rates go up, Indian rates do not have to go up commensurately. Inflation in both the countries is roughly the same. Their yields are 2%, our yields are 7%. So I think to that extent we should have not no significant impact. And we have seen large FI selling already in the last year or so, almost 35 billion dollars worth has been sold, and all of it has got absorbed by the local market. So I think our dependence on foreign flows has also reduced as this experience of last 1 year shows. So even if there are some further FI sales, I think the impact it will have on the Indian markets, to my mind, should be quite moderate. The uh, However, I still feel that given the uncertainty around the oil prices and the interest rates in US, which are likely to go up, because let us remember that US interest rates were around 5% in 2005. They were even higher before that, and right now they are 2%. So there is reasonable room for US interest rates to move up. We don't know how much over what time, but clearly the room for them to move up is quite reasonable. So I feel, given this uncertainty around oil prices, given the uncertainty around US interest rates, I think it would be make sense to phase out our investments in this type of environment. Large lump sum investments would make greater sense around market dips or when markets are cheap, which is not the case. If you are expecting compounding type of returns over long periods with these two uncertainties, I think this is a good market for phasing out our investments. So Abhishek, this is what I wanted to share, and maybe I've left out few things, but I'll try and cover this in the Q&A. So over to you.
Right. Oh, thanks a ton, sir. This itself is a book, good big data points for all our investors. So before I pass on questions with you, I'll request all our esteemed customers who have joined over this call. There is a question panel on. Please write your questions if you want to ask. I have already received some questions on it, but anybody who wants to write up their questions, please put across your questions and I will try to put across those questions to Prashant sir. So sir, before other questions come up, you have already touched upon Fed hikes and in a bit, but what is your sense on the monetary policy with with RBI with India? How you think that will pan out and how our interest rates will impact or the bond yields will impact the markets?
And so I think Abhishek, opinion is divided here. Some economists feel RBI is behind the curve, some feel it is not the case.
Right.
I really don't know, but whatever little I understand and whatever I have heard, the RBI governor, he seems to be suggesting they are pro-growth because underlying demand conditions in India, especially in the low-income groups, are weak. And so I think they will prioritize growth, and they'll be supportive uh, 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 of growth. But in the end, these things can change over time. If inflation persists, if growth comes back, I think interest rates could move higher. But as I said earlier, see, Indian yields are 7%, which is somewhere in the middle. If you look at last 15 odd years, or maybe slightly longer, 20 years, Indian yields have touched a low of 5% and I think a high of 9 or 9.5%. So we are right in the middle. So even if yields have to go up in India, I think they should not go up a lot. And therefore, to that extent, I feel interest rates should be less of an issue in India. And there's one very important point about India. See, in India, you expect earnings to grow 12 to 14% longer term, and if inflation is high, maybe 12 to 16%. So even if you increase the cost of capital by 1%, it will reduce the PE multiples somewhat. Maybe it will mean for 6 months the fair value does not go up, or maybe for 9 months. But a 12-14% compounding in rupee terms is a pretty strong number, and therefore over time we have seen in India the returns of from equities are to a very large extent dependent on growth, and interest rate movements have a fairly small impact
Right, right. So
because the
there are
business
certain
values are growing, earnings are growing. Yeah. Sorry.
right. So there are certain sector related queries which our clients are asking regarding your view specifically on IT sector, looking at the valuation where are, and there was some uh, I'll not say a downfall, but a small dip which we could see in the IT stocks of late. And then your views about mid and small cap and how an investor should place his bets across large cap, mid cap, and small cap, if you can share some.
Sure, Abhishek. So, Abhishek, I'm sure, I mean, we can expect few more questions around sectors. So, let me try and give you an overview of
Yeah.
what my thoughts are around various sectors.
Yes,
I
there
mean,
are
clearly,
multiple questions piling up. Yeah, yeah.
yeah. So, clearly, these are individual views, and we views can also be wrong. So, but what I feel is that the consumer sector, both staples and discretionary, and IT sector, these are very good sectors, secular growth, solid companies, sustainable competitive advantages, but the multiples are rich. I feel that one should have modest return expectations from these sectors. Also, what is happening, as I said, until some time back, we were in an environment where large sectors of the markets like banks, capital goods, commodities were struggling in terms of profit growth. Now that profit growth is fairly broad-based, and when profits are growing across the board, then there is lesser reason for you to chase the same growth in more expensive companies. And therefore, I think this environment where sectors that are a lot cheaper and which will exhibit similar or close to the growth of these sectors, uh, so they will become relatively more interesting. Therefore, I personally feel, given this change in environment and the multiples, the consumer and the IT sector are expensive. The most other sectors, I would say, are in the fair value zone. So whether you look at banks, whether you look at capital goods companies, whether you look at automobile companies, whether you look at pharmaceutical companies, they are somewhere close to fair value, which means return should be in line with the underlying growth of these businesses. The sectors which I still find cheap is the most disliked sector. It has underperformed the most, and that is the power sector, the utility sector. And we have discussed this often. I have commented upon this often, but I
Right.
do feel that this is a sustainable sector. It's a growing sector, and it is still quite cheap. But there are clearly a whole lot of investors who don't like this sector. Yes. As far as small mid caps are concerned, large caps are concerned, I think this issue is often, uh, people give more than what is desired emphasis on the capitalization of a company. If you look at the long-term returns of Nifty, which is a large cap index, of a mid cap index, and of a small cap index, you will find all these three indices returns are within plus minus half or 1% of each other. So that clearly suggests that the returns across these three groups of stocks on an average are very close to each other. We do get into periods when one sector, one segment strongly outperforms, like it I think happened in 14, 15, 16, or I'm slightly confused, 15, 16, 16, 17, 18 probably. For 3 years back to back, small mid caps did extremely well. And no, I think it was 15, 16, and 17 years. And then large caps became cheaper. So this, I mean,
Right.
there are these phases of these markets, but today when I look at these markets, I think there is no material, uh, divergence in valuations. On the margin, I feel that generally because risks in large caps is low, especially in market downturns, I feel two-thirds to three-fourths of the portfolio should normally be invested in large caps, and the balance one-third to one-fourth in small and mid caps. Yes.
Sure. And that's how, in fact, we also guide our investor to participate into large and mid cap as majority with two-third of the portfolio, or 75% of the portfolio, and the remaining can be participated out there. So they are investors. We want to know about how the balance advantage category, which is the biggest fund, or the prudence, earlier prudence fund which you manage, how it is shaping up, and what are the new sectors or new way of you are dealing with, because there's a lot of questions around balance advantage, dividend payouts, and all that. So if you can throw some light on that fund, because that fund is the most accepted funds, if I have to say, in that sense, from all our investors.
Sure, Abhishek. So one, I think it's clearly one of the largest funds in the industry, and it is
Right.
also doing extremely well. So I think one thing which I have defended whenever performance was weak, that no funds in India are large, and I think this is one good time to say that with higher confidence, because it's a large fund and performance is clearly very strong across time periods. So I think we must both good large and small funds will have weak phases, weak times, but size should be measured relative to the market. And in India right now, no fund is large. Even the largest funds would be zero point 0.1 or 0.2% of the market. So that was point number one. I think what we have done in this fund successfully is that, uh, see, pre-COVID, this fund was positioned for an economic recovery. So we were overweight banks, we were overweight capital goods, and we were underweight consumer stocks. When COVID hit, this strategy impacted the performance because there was clearly, uh, uh, I mean, it was COVID was very negative for market economic outlook, for capex outlook. NPAs also were likely to go up. So banks, capital goods were hit, and consumer stocks outperformed because they were much better placed. So that hurt the performance that year. But as I have always said, that environment can change. But if you buy strong, sustainable businesses, that have the ability to ride out a tough environment over time, performance will come. So I think clearly that has happened. And what we also did when market cap to GDP in India fell to close to 5%, 50% after the sharp fall in the markets, despite the pressure on performance, we increased allocation towards equities sharply. And we actually crossed 80% exposure to equities. And some people thought that was too aggressive. But when you have great value, then at that time you must put money to work where there is value. And over time, I think that strategy has done extremely well. And of late, of course, we have reduced exposure to equities. Uh, and again, I mean, in this fall, we have tried to increase it once again. So I think our asset allocation has worked to our advantage. And also, in the recovery phase post COVID, the sectors that we were overweight, like banking, capital goods, have done extremely well. And sectors that we were underweight, like consumer, have lagged. So I think these are two reasons why the fund has done quite well. I think longer term, this category, I mean, while equity allocation varies across fund houses, in our case, I think the way we do asset allocation is we take a medium to long term view of equity valuations relative to bond yields and also the earnings growth outlook. And our exact equity allocation will be a function of how equities are valued or how attractively they are valued relative to bonds. But clearly, I'm not suggesting that we are able to time the markets over 3, 6 month, 9 month periods, but we do take a 2, 3 year view of things. And thus far, that strategy has worked well for this fund.
Okay, so sir, there are certain stock specific questions I know you'll not be able to take, but just a general view which investors wants to know about REITs and tire sector. So if you can, because that's very specific questions which have come up. So
I think REITs are a good asset class, and we actually have some exposure there in the Balance Advantage Fund. And I think it's a good asset to own, and it has uh, part characteristics of a bond, part characteristics of equities, not as risky as equities and not as safe as bonds. So I think the risk to uh, this is if interest rates go up sharply, then these are like they have some bond characteristics with very long durations. So you could see some underperformance there. Uh, as far as the tire sector is concerned, I think this is a sustainable business because even EVs need tires. So clearly, this business is not at risk of a technology disruption. To that extent, is a sustainable business. Demand for tires is relatively less cyclical. The near-term margins are under pressure because clearly the rubber prices, chemical prices have gone up sharply. But over time, I think these will get passed on. I would say this is a reasonable sector. Yes.
okay, I think well, while we were interacting last time, also there was multiple questions on electric vehicles, and that continues to be being part of every discussion. I believe wherever you are on the screen or you are interacting with investors, people do talk about it. So if you can say something on the electric vehicle side.
No, I think with every passing day, it is becoming increasingly clear that EVs will continue to gain share. So it is happening in the world, it's happening in India. And I think EVs in India will come first in the scooter market, and we are already seeing that. There are cities, I think, where E2 wheelers have a high single digit market share also, and it continues to increase. I think goods three wheelers will also see the transition. City buses are seeing transition in many cities, of course, supported by government interventions. Uh, I think fleet taxis will follow. Wherever the running is high, it will make more economic sense. And general expectation is, as Mr. Gadkari has also been saying, that in the next 2 to 4 years, we should see cost parity. So I think before the end of this decade, we should see significant EV penetration in India. And when we are investing, we have to be careful that the companies that we are investing in, how are they likely to be impacted by this transition. Therefore, we are slightly cautious on this space, because when a big product or a technology shift takes place, it has been seen in the past that the market shares and the profit pools can get sharply realigned. So we have to be careful around that. I think longer term EV has significant promise for India. If you imagine an India without oil imports, then you will become a Sone ka chidiya once again very fast. If you save $100 billion a year of oil
Right.
imports, you can imagine how prosperous this country will become. And EVs have that potential to significantly reduce India's dependence on imported fossil fuel. I think because EVs need electricity, and which you can generate from local, sources of energy, whether it is coal, hydro, solar, or wind. So I think the faster we adopt EVs as a country, I mean, one, of course, it is great for the environment, and second, I think it is great to it has the potential to increase India's prosperity, to rid India of its current account deficits. And if that happens, there is no reason why the rupee should continue to depreciate. And if currency does not depreciate, the purchasing power will go up a lot faster. So I think this is a very good development, and it has tremendous promise for this country over the medium to long term.
Sure, sir. One last question on sector is on the real estate side, the real estate and house development sector as a whole, which now the theme is as an emerging. So your views on that, sir.
Well, I think, see, this is a good sector, and the home affordability in India is one of the best in a long time, because home prices have been flat for a while, and mortgage rates are clearly the lowest ever. So I think this is a growth sector. This is also a focus area for the government. So clearly, I think this is a good sector.
So I will not ask you this question. I'll just share with you because people, there are some investors who are asking your views on COVID fourth wave, and which I don't know. That's because of their trust in you that you will have your own insights. But so you want to take that because it's
Yeah, I mean, I am clearly not an expert, and even there has been a lot of learning that has gone into COVID, because we were dealing with it for the first time. But I mean, all I will say is countries are opening up one after the other. Today, I think Mumbai and Delhi government has said you don't need not even use masks. So I think the government certainly would know a lot more than what you and I would know. And I think we should feel comforted that this seems to be ending. And I mean, there can always be a fourth wave, but today I don't think there is anything to suggest that. And if you look at the second and the third wave also, the economic impact of these two waves was extremely small,
right.
both on the economy and on the markets. Because by the time of second wave, the world was much better prepared, businesses were much better prepared, and the world and we are geared to work from home. So I think the best way to respond to this is we hope there is no fourth wave, but we think even if there is a fourth wave, unless it is completely different from the second and third waves, the economic impact of this should be much less.
Sure, sir. So some questions again are on stock specific. So I'll request all our investors, clients, stock specific questions are to be avoided uh, because of regulatory issues. Uh, so one question is on rupee, which though you have touched upon it, and on the defense sector, and these are the two sectors, and then in one specific there are some clients who are NRIs who are asking for investment ideas and strategies for NRI. Well, it doesn't change the strategy. If you are an investor, you are an investor, NRI or resident. But sir, if you have any views on that.
See, NRIs, to be honest, I mean, I am not too familiar with the regulatory framework. I mean, all
Sure.
I feel is that there are some bonds of Indian companies that are available at higher yields, and they could look at those because NRIs would understand the strength of these companies a lot more compared to how the global markets price them. So I think that could you could take a look at that. As far as defense sector is concerned, I think this sector has significant promise, and it shows in our portfolios. Uh, and I think the reasons are few. There are multiple few reasons are there why this is a we are positive on this one. Clearly, the government is sharply focused on indigenizing the defense equipment, and this was even pre-Ukraine. So Atmanirbhar Bharat, Make in India, and we have seen large number of orders being released to Indian manufacturers. For the first time, many platforms are being built in India. The LCA is a very good example of that. Uh, India is the world's, I think, largest arms importer, and clearly, if you were to shift a part of that to local production, it is a large opportunity. The second reason, of course, is what has happened in Ukraine and how post Ukraine, post COVID, I think countries would want to develop supply chains of energy, of critical equipment locally so that these are not disrupted in difficult situations. So I think it will further encourage the government to prioritize local supplies. And third, this is an area where the entry barriers are extremely high. I mean, imagine how many years it will take for someone to develop, test, get it approved, and deliver an aircraft. Probably 2 decades or 10 years at least. So I think the entry barriers in this space are very significant, and therefore the companies enjoy significant competitive advantages. So I would be favorably inclined towards that sector. Rupee, I think, hard to say, especially near term. It would depend to a large extent on oil prices. See, if oil prices fall, it would could even prompt or encourage FIs to come back to India. So lower oil prices means lower CAD, and on top of it, it could also mean higher capital flows. On the other hand, if oil prices were to spike up, it would moderate the market's outlook near term. It could also lead to capital outflows. So higher oil prices impact not just the current account but also the capital account. So I think in the near term, I feel this is my guess. INR would be impacted significantly by where oil stabilizes in the next few months. But clearly, longer term, we have seen the rupee depreciates equal to the inflation differential between India and US, and this depreciation takes place in step functions. So it is not that it is depreciating 4 or 5% a year. All of 2001 to 2007-8, it remained stable, I think, even slightly longer. So hard to forecast when the next correction will take place. But now there are some reports that are suggesting that given the sharp increase in current account deficit in India, some people are expecting the rupee to depreciate.
Right. They are. I'm probably this is the second last question which I'm taking, sir, because I believe uh, we're going short of time. This is there. I think multiple clients have asked about Fed, and interestingly, on the in inversion of the yield curve between 2 years and 10 years. So, our the clients' questions are based on will there be a recession in US? What will be the impact on India? Though you have touched on it, if you can just share what's your view and what how that will impact Indian economy or Indian stock market.
See, these are clearly there are a lot of uncertainties, and I read the same papers what your clients have read, and the yield curve is inverted today does not mean it will remain like this. US may go into a recession, it may not go into a recession, we don't know. What we have seen that in the early years of economic recovery, when interest rates are rising, it is accompanied by very strong economic conditions, and naturally so, because when will you increase interest rates when economic conditions are very strong? It is only after a while that higher interest rates start slowing down the economy. So these are very general comments, and but I think the most important point here is that growth in India has been pretty secular. If you look at last 40 years, uh, we have seen high interest rates in US, low interest rates in US. We have seen US economy strong conditions, weak conditions. But growth in India has been pretty secular. So I think what matters more to India is oil prices. And if uh, oil prices are low and US economy is not doing too well, I think it is okay. India is not much impacted. And please appreciate that the growth of India's exports is more by market share gains, and it depends to a small extent on the world GDP growth, because world GDP is growing close to 3% a year, but we target to grow our exports in double digits. So that means bulk of the growth is coming from market share gains. Look at the IT industry. It is growing in high single digits, low double digits, and in the past it has grown at 20, 30, 40, 50% CAGR for many, many years. The world economy, the world IT spends have never grown anything close to that. So I think India's export share is extremely, extremely small, probably 1 or 2%. So I don't think weak economic conditions in US or China are going to impact India meaningfully. If at all, they may even benefit if it leads to lower oil prices. So I don't think we should worry about these things. We should instead focus on how our local economic conditions in India, how our local business conditions in India, is growth likely to accelerate here or not? Yes.
Right. So last question before we wind up, because I know the questions will keep on coming up, but it's on e-commerce and the house view on e-commerce and pharma sector, and I think there are certain stock-specific questions which I'm again avoiding. So this is the last question before we summarize this call today.
Sure, Abhishek. So I think pharma is a very heterogeneous sector. What I mean by that is that the different companies have different businesses, different variables, different business models. So it is very tough or improper to generalize this sector. Having said that, I think this business broadly has two segments. One is the local formulations, the local medicines, what you and I buy, and the second is exports to US. This sector has gone through a very difficult last 5 6 years, because the in US the pricing of drugs came under tremendous pressure. I think as a result of that, companies have since cut costs, uh, and uh, what we are feeling now is that the next few years should be promising for this sector in terms of profit growth, because US margins have probably bottomed out. Indian markets continue to grow at a steady pace, and companies have clearly cut costs. But simply profit growth does not mean good investments, because you have to be also mindful that how much of that growth is priced in. But generally, I feel the sector is fairly valued, which means return should be in line with growth of the underlying businesses. Coming to e-commerce, uh, I think there are a lot of learnings that we can take from what has happened. And I'm not saying I have all the answers. We have to learn as we go along in this sector. But few thoughts. When you look at these type of businesses, they there are two types of businesses broadly. One where the road to profits is reasonably well known. And then there is the other where even the models have not stabilized and we don't have clear sight how some businesses will make money. They are acquiring customers, they are meeting some need, but how will they make money, that is still not clearly understood. So my preference clearly is to the first type of businesses where at least the road to profits is reasonably clear. Uh, Now, when you look at the valuations, these businesses are clearly uh, a fraction of the ultimate potential of these businesses. But still, the when you look at I mean, to our best assessment, the valuations are discounting in lot of growth in these businesses. And when we try and estimate these businesses 10 years out, given India's economic potential, income levels in India, we think these businesses may generate, even from current prices, low returns, not very attractive returns. The uncertainties, the execution risks, the competitive risks are significant. So I would still not be very optimistic on this sector. I think one general learning, what I would like to say here, is that people get excited about something new every now and then. And it happened into technology in 99, it happened to infra in 2007, it happened to pharmaceuticals around 2013-14, it happened to small mid caps around 2015-16, and now it happened to this space. So whatever becomes very popular, whatever has given a lot of returns in the previous few years, that becomes very popular. And but in the end, these disappoint. And the way I explain this is that when a business has already given huge returns, it has probably become expensive. And if everyone is interested in buying the same businesses, they should have become very expensive. And expectations are extremely high. And we have seen time and again that very high growth rates do not sustain for long periods of time. So I would say that this is one good uh, example of what can go wrong with stocks and why one should invest where one understands, and also the why one should remain diversified across sectors. Because without, I've seen once in a while direct portfolios are not diversified appropriately. And what has happened in this space, I think, brings out the need to diversify your portfolios at all points of time. And that is what leads to good outcomes from equities over longer periods. Yes.
Definitely, sir. That is what, in fact, that's what we guide our investors. A portfolio being professionally managed definitely adds more value in the long-term basis. And just to summarize to our investors about the key queries, that what will be the impact of Fed and the war around. As for Prashant sir, the biggest threat to us is crude in the long-term basis. One should, if the crude is intact, one should not get too much carried away with the rising or the moving interest rates across. Broadly, India looks at it at a fair valuation. One should stagger his investments over a period of time and look for opportunities if there is any correction to participate in the market. Across the platform, the market looks not very undervalued, but it's at a fair valuation. So please get in touch with your relationship managers to understand. I know there are certain questions regarding stocks. So if you want to know more about stock, you can refer to the relationship manager of HDFC Securities for a research report on that script. If it is available on it, if it is under research coverage, we will definitely guide you on it. I can say on Prashant sir behalf that recommending stocks is not part of his I'll say an activity, or he's not allowed to supposed to speak on stocks, not even pass on those stock related questions. And Prashant sir, thanks a lot for coming up over the first day of the year, of the financial year. And we wish you and all our investors are very happy investing for next 365 days in this financial year.
Thank you, Abhishek, and all the best to all of you friends. Thank you.
That will conclude our call. Thanks all our customers for seeking out time and joining it. It was a pleasure having you all, and definitely we are overwhelmed to have Mr. Prashant Jain once again to interact with you all. Thank you, everybody.
Thank you. Thank you.
Thank you.